Test, test.
Absolutely.
It's test. It becomes active. If you want,
You have the institution.
the light becomes green and
you're
on.
And then the hedge funds are all.
The green.
Okay.
And it's on.
Like this.
So, hello everyone. Let me welcome you to the ESM SUERF Policy Conference on Global Disruptions and Debt Sustainability. So this is the first time that we are doing it a little bit differently because we're doing it together with SUERF. So I'm welcoming you on behalf of the organizing group, which is Ernest Gran and Dragana Popovic from SUERF, and then Giovanni Callegari, Silvia Calò, Maria Campa, and myself from the ESM. What we're also doing this year is we're having this conference about disruptions and debt sustainability. And you think, what does it have to be about this year? And then one goes back 5 years back, and we were in a very different world. Low inflation, negative interest rates, stable, moderate, stable growth. And now we're in a totally different world. High inflation, high interest rate, volatile growth. But at the same time, this is a world that you get the sense that more is possible. The sense of possible in European policy is different from what it was before COVID. And then you think, okay, that's great, but then let's not get carried away. So what we're doing now, which enhance the set of possibilities, is likely to come with a bill at some point. And this is why this is about geopolitical disruptions and debt sustainability. Just please keep in mind that online participation is not limited and the event is recorded. So it's not Chatham House rules, it's open to everyone. And without further ado, for those of you who have noticed that I am not Ricardo Reis, I am now inviting the gentleman himself for the keynote speech. Thank you.
Well, thank you very much. Thank you for inviting me to be here. It's a pleasure. I've been working or collaborating with ESM now for a little bit over a year and learning a little bit about how the organization works. And it's a remarkable organization for being so young and all the challenges that it has to take on and how to think about them. So it's a pleasure for me to just kickstart this conference with a few thoughts. Oh, wait. Oh, that's not me though. With a few thoughts that hopefully will be helpful. Let me see if I find my slides though. Where my slides would be? No. All right, I just assumed the slides would have been up. I guess I should have checked before. Well, but I'll get started if that's okay, so that we don't. I'll speak without the slides, and then eventually I think they'll show up. Yeah. So someone look at them. Maybe they are. So the remarks I'm going to give are not impromptu remarks or remarks for this conference, but rather they're just an abridged or a shortened version of a lecture I gave at the IMF annual meeting 3 weeks ago. The Mundell-Fleming lecture, and which title was Financial Repression in the 21st Century. I think it's an important topic. I'll try to convince you of why it is. Not only an important topic for policymakers, but also one in which research over the last 10, 15 years, I think can be brought to bear in very useful ways to what I think will be an important challenge over the next 5 to 10 years for policymakers. The world right now is facing what I'm going to call a twin debt problem, not a twin deficit problem, but a twin debt problem. What I mean by that is that if you look at the stock of public debt over GDP, it is really very high. Depending on whether you use the numbers today or the numbers projected in 5 years, you conclude that public debt GDP is now either at the level of 1947 or 1945, essentially as high as we have seen since the end of World War II. And we can no longer say that this was a pandemic phenomenon, because after that exploded in 2020 and 21, and it did fall in 22 and 23, Since 23, it has been rising pretty much everywhere, back on a trend towards hitting, I think the IMF projects 100% of GDP world debt by 2030. Moreover, it's also not just the US. Emerging markets, if anything, have had a larger increase in percentage points of GDP of the debt since, say, 2019. Twin why? Because on top of this public debt problem that is well known, there is also an external debt problem. Maybe not a problem, but certainly external debt, which often has gone under the name of global imbalances, in that there's quite a few countries that have accumulated very large external debt, which of course means that there's also some countries with very large external credits. Now, even though on net you must have some creditors and some debtors, on gross terms, the gross liabilities, either in total or even only of debt instruments, of pretty much almost every country in the world that we have data for in the last 20 years, have increased quite significantly. In the case of the UK, if you really do in gross, we're talking about 400% of GDP, or 550, because of all the intermediation that happens, and there's a lot of assets on the other side. But even if you look at the US, you look at things like external debt to GDP, and we're talking about 50% in debt instruments and 100% if you look at all instruments. But even for France, just since we're in Europe, France, Italy, and others, we have a very large amount of external debt. So twin debt, because we have both external debt and we have public debt. Policymakers, unsurprisingly, would look today and say, "Oh, can I go? No, not yet." Would look today and say, would naturally look at the situation and be tempted to tax the foreigners. How do you solve a debt problem that is partly an external debt problem? Let's tax the foreigners, and we'll solve both problems in one go. And perhaps unsurprisingly, what have we done in the last 9 months? All of a sudden, we're talking about tariffs, a way to both close an external deficit as well as collect revenues to pay the public debt, as has been very clearly assumed by the current US administration, those two sides of solving the twin debt problem. Of course, when you look at imports to GDP, which in the US are roughly 20% of GDP, you realize that there's only so much money you can raise. Even if you raise tariffs to 10, 20, 30, 40%, it's hard to see how, especially as you account certainly the elasticity in response, how you'd be able to raise more than 1 percentage point of GDP, maybe 2 at best, and certainly not in a sustained way in order to solve your twin debt problems. So I think it's also a matter of time. If it has, I would even argue it's happened already. Oh, thank you. Or if there was a twin debt problem. It's only a matter of time to say that to tax the foreigners, instead of the flow of goods, let's tax the holders of the stock of credit. Because with gross debt liabilities that are that high, again for the US 80%, you don't need to have a tax of 34% as on imports of flows. Have a tax of 10% on the holders of the stock of debt, and you raise 8% of GDP overnight. That is a very tempting proposition, especially if the holders of the debt are foreigners. Let's just tax those guys and solve our problem that way. Doing so, taxing the creditors, is what I will call financial repression. Why do I say this? Is certainly an old term. Let me be clear about how I'm defining it. Financial repression are policies that both loosen the budget constraint of the country as well as the government by transferring resources from the holders of the debt to the country. I'm going to exclude outright default from this definition because sovereign debt default is a topic in itself. But I have to say this is my definition only insofar as there is a much narrower definition of financial repression sometimes, which refers solely to getting banks to hold government bonds of your country. I'm being much broader than that. But this is also a definition that's narrower from the classic one put forward by Ron McKinnon 50 plus years ago, which referred to financial repression as pretty much any distortion in the allocation of credit. So pretty much any policy would be financial repression from those views. Financial repression in the 21st century, because financial repression, for those of you who have studied some economic history or financial history, was very common during the Bretton Woods period. The whole Bretton Woods, in part, was sustained by financial repression, and we paid for large chunks of the World War II debt using financial repression. But partly because of the work of Ron McKinnon and Ed Shaw, it fell into disrepute as in the 1970s, we realized how distortionary it was, and especially as trying to replace in the 1980s led to sovereign debt crisis a little bit everywhere. And since then, we went through 40 years of going away from these policies, financial liberalization being the buzzword that meant essentially reducing financial repressions. Insofar as my 10-minute introduction or 5-minute was persuasive to you that either the policymakers in your country or have already thought about it, or they're about to start thinking about, why not tax the debt and the holes of the debt? Financial repression policies will be coming soon. If, again, I'll repeat myself, I think they have come already in many ways. And so what I want to do in this lecture is, one, conceptualize them using something that will be familiar to this audience, debt sustainability analysis. I'll show you debt sustainability analysis tools are going to be useful to think about financial repression. Two, I'll tell you how the literature has actually allowed us, the academic literature in the last 10, 15 years, to both measure and assess how large this financial repression can be at solving a twin debt problem. So let me do the conceptually, and I'll use just words, no equations, although many of you will recognize some equations behind this. It is a matter of accounting that the change or the increase in the net liabilities of any debtor are going to be equal to the sum of, one, the payouts that have to be done from these liabilities, plus the deficit, or if you want, negative of the net income. This is accounting. There's no economics at all behind this. This is the definition of the liabilities in the first place. There is one important economic concept, which is the idea of a no Ponzi scheme on liabilities. And that is that even though I may be willing to lend to you at a discount because of my generosity and because of maybe you repress me or not, eventually I want to be paid back. I will not give a full transfer to you voluntarily without anything just back in return. If we combine that accounting with the simple economic result of no Ponzi schemes, I don't have to think about efficient financial markets, no arbitrage, simply that there's no Ponzi scheme. The combination of these two leads to the following result, that the debt is equal to the expected present value of net income minus the change in the market value of the debt plus the expected present value of whatever discounts you gave me in lending to me at a below market rate. Let me apply this right away to a country or a government and talk about financial repression in this context. Once you realize that public debt is equal to these three terms, then financial repression is nothing but a way to lower each of these terms on the right-hand side, and there will be three types of financial repression, because that is how you will transfer resources, going back to my definition, into the holder of the debt. First term, if it's a government, this is the present value of the primary surpluses. If it's a country, the present value of trade surpluses. This is the conventional term that debt sustainability analysis spends all of its time, traditional sustainability analysis, thinking about in some ways. What is financial repression in this context? Tax the financial sector, a direct tax on the holders of the debt, which could be, for instance, a withholding tax on your returns on holdings of treasuries if you're a foreigner holding treasures, for instance. Or some stamp tax, stamp duty tax of some form whenever you lend to the government would be another example. Second term, market devaluation of liabilities. Of course, the classic is sovereign default, where the liability is worth nothing. But in terms of financial repression, the main one here for a government and or a country is to have unexpected inflation or depreciation of the currency. The debt is now worth less. Financial repression happened here through that surprise channel. The third term is the one that researchers certainly spent most of its energy in the last decade, is on these discounts. They depend on the composition of the assets and the liabilities. But there's one term of this that is very familiar to anyone who, like me, comes at this from a tradition in monetary economics. Seigniorage. When I issue currency, for some reason, people like to hold it, even though it pays no interest, even though the market interest rate may be 4 or 5%. That gives me a revenue because people are willing to lend me, give me resources in exchange for the currency for whatever services that currency happens to provide. And that present value of discount relative to the market rate that you give me because you like my liability, you like my currency, is the classic version of what this is. In the international literature, the seigniorage was, you may say, rediscovered or re-expressed in terms of the literature on the exorbitant privilege. Turns out that you are willing to, relative to the US, hold its liabilities at a below market rate. You give a discount to the US Treasury, Why? The literature has argued because the US is selling you insurance. This is an insurance premium because the US is giving you a liability that will appreciate in value in recessions. The dollar, as the dollar appreciates in value in recessions. Either way, these are discounts. Financial repression here emerges, starting right away with the currency, because, as Milton Friedman famously derived 60 years ago, and the insight is still the correct one, you could just, of course, supply enough currency to satiate the demand for it and satiate all the services. This is, after all, a service provided by government liability, and the key Friedman insight was, I can always issue more liabilities. There's no cost of issuing a liability. So if you happen to have an unsatisfied demand that's making you give me a discount, I could potentially, if I wanted to optimize, I could potentially issue as much up to the point where there is no longer any discount. To repeat myself, perhaps, the three classes of financial repression, and this is why they're conceptually distinct, is that the first one raises resources directly independent of the stock of the debt you have. The second one raises resources by changing the value of that stock unexpectedly. And the third one raises the flow of resources that are proportional to your holdings of the debt or the stock of the debt. Importantly, if you are willing to assume classic economic benchmarks of information, rationality, efficiency of markets, then financial repression has a zero impact. There's a very important zero benchmark, namely, for instance, a tax on returns on holding the bonds raises the first term, but lowers the third term because it gets priced in right away through a higher pre-tax interest rate being charged on holding those bonds in the first place. Likewise, a permanent increase in the value of the flow of the services will raise the third term, but insofar as it gets priced in right away, instantly in an efficient, frictionless financial market, will also mean an appreciation in the value of the debt, which will lower the second term. So there is a theoretical benchmark that has led to these terms, this financial repression, I think, being partly ignored, which is that you get a lot of neutrality or zero results here. But when you look at the data, this can be large, and I'll illustrate this, for large periods of time, often decades. And moreover, it's something that you can manipulate. But to see that, let me go over the three forms of repression. Surpluses. You could tax the value added of the sector. The US collects 0.15% of GDP on value-added income taxes and value-added taxes on the financial sector. How large can that be? Hard to believe it can be much larger, given that the financial sector's weight on overall on value-added is 6 to 7%, depending on the year. But what about taxing the flows in the financial sector? Luckily, Brazil did that. Or not luckily. Brazil has tried that, starting in October 2009, with very large taxes on capital inflows, at the time with an attempt to, stop some hot money falling from the global financial crisis and generally manipulate the current account. Well, there's been quite a few papers on how successful those policies were. More ignored, but with available data, is how much revenue did they raise? At its peak, these taxes, extensive taxes on all capital flows coming into Brazil, the largest we've seen in an economy that has large flows, 0.13% of GDP. Finally, in the picture here, taxing the stocks. If you can't tax the value added, the flows, the stocks, Ireland famously in 2011 put a levy on pension funds assets, which was 0.6% at first and then rose to 0.75%. How much did it raise? As total revenues, it raised at its peak about 1.8%, which as a share of GDP was a little bit above 0.6% of GDP. Tremendously politically unpopular, not to be repeated again unless in a complete emergency. So when we look at the first term, can we do it? Absolutely. Is it done? Absolutely all the time. How much money can you raise of this? Looking at the most extreme international examples, you can barely make it add up to 1% of GDP. Devaluation. Here's an interesting exercise, I think, that I enjoy doing. It's a little bit of a cousin of some that Francesco Bianchi has done, which is, let me start with the 𝗲𝗂 forecasts in 2019. The 𝗲𝗂 has a wonderful thing, which is that all the terms add up in the 𝗲𝗂, so all the forecasts for all the terms in the government budget constraint have to add up. And then let me compare what it forecasted for growth rates, interest rates, surpluses, inflation, with the realized 𝗲𝗂 result in 2024, and subtract one from the other. Remember, they add up, to get the unexpected changes in government debt from each of the 5 components if you want an evolution of debt. And from there, figure out how much did we surprise, at least from the IMF economists, lowered the amount of debt that we have. You see that Italy devalued, unexpected, inflated its public debt by the largest one, because they had the largest debt, of close to 10% of GDP. Okay. But even the US was around 8% of GDP. So can you inflate away the debt? Can you financially repress unexpectedly? Yes, you can. But on the right-hand side is that exercise being done since the 1970s, and using now forecasts for the SUERF professional forecasters. You see here that 4% is the first 2022. I could have added the other one, but then the graph wouldn't be so visible to get to the total 8% because it was those 2 years. On average, how much inflating away of the debt of the US achieved in these 50 years? Zero, almost literally zero, 0.021, okay, in terms of GDP, okay? Yes, you can do 3.6% in 2021, but you can't sustain that. And likewise, will it be able to keep on inflating the debt away after having done so successfully in the last 3 years is highly questionable. In fact, your ability to do so relies fundamentally on being able to both generate inflation, 2, inflation that persists during the duration of the debt, and 3, surprising agents in doing so. And yet, if you look at the data on inflation expectations right now, at least that's something that I've been spending a lot of time on, as you see there, in the UK data, what we see is that swap prices now are overreacting to expected inflation by a fraction of 20%. So whenever we have an increase in actual expected inflation, the swap prices increase by much more than they would have. When you look at US professional surveys from the SUERF professional forecasts, right now, and this was not the case for 2019, any news in CPI release dates leads to a significant change in 10-year expected inflation. So news about last month's inflation is affecting 10-year expected inflation. Expected inflation is much less anchored. And third, the cost of buying insurance against tail events in the euro area, in the UK and the US, has doubled in size and never has come back relative to pre-2019. So across all these, what it seems that if we were to try to inflate again the way the debt, do financial repression through inflation, unexpected inflation, the impact would very likely be much slower than those 8%, if any at all. Third, the discounts. Conceptually, think about the demand for a particular government liability. As I told you earlier, you would eliminate the financial repression if you supplied enough of that debt so that it would pay no discount relative to an R-bar market rate, that the interest rate on that, charged on that, plus whatever change in valuations as well, would just be equal to 0. In fact, we see that for many government liabilities, there is a discount. That discount means that there's a financial repression there given by that rectangle there. You undersupply a government liability, it pays a low interest rate, that rectangle is the amount of resources you've transferred that way. Note that importantly, and a mini insight if you want to call it that, is that measuring all the surplus is going to be very hard. I'd have to pin down what is the demand for all the different government liabilities. Measuring the financial repression, though, only requires accurately measuring the discount as well as measuring the quantity, and measuring its local potential only requires knowing the slope of the demand curve at that point. And luckily, the literature has been busy in the last 10 years measuring each of these. What are the major, actually almost exhaustively, all the government liabilities, and let's map them into the services they provide. Currency provides anonymity. Deposit central bank provides liquidity with which banks can settle transactions. Long-term bonds provide a safe, steady income for those who want to retire and have a safe pension. Issuing in dollars provides access to the dollars, which in a world in which invoicing is very much dominated by dollars and makes that it leads to a desire to have store of value in dollars as well. And finally, government bonds, especially of less than 10-year duration, give pledgeability. They can be pledged as collateral in a series of transactions in financial sectors. For each one of these, having identified the main service, we can then measure the discount that they earn relative to an equivalent. For instance, with currency, the discount is given simply by the short-term nominal interest rate. For the deposit central bank, there will be the gap between the interest on reserves and the interest on interbank rate. For the long-term bonds, it will be the 30-10-year spread. And for the currency issuance, you will be comparing the ability of the US government to issue in dollars versus my ability to buy a German Bund and use forward contracts to convert that into a payment in dollars. And I can measure the discount by essentially the CIP deviation between the two. Finally, for the pledgeability, I can either measure what is the interest rate paid by bonds issued by supranationals, like the ESM, which cannot be used to pledge as collateral in many transitions, or compare this with corporate bonds, or even compare with different market returns. And doing this in different ways, I can go and measure for you there what was the revenue for the US. I'm going to focus this on the US, this part, as a percentage of GDP that was collected, and it was potentially quite significant. First of all, you see that really the main revenues are the US dollar denomination and the pledgeability. But note what happens when you measure those for the last 4 years. Unexpected inflation, significant. Remember, the 8% divided by 4 years, that's 2%. But the other ones have all significantly declined. Right now, the US government borrows more expensive than corporates. Right now, a Bund traded into a payment in dollars pays less than a US Treasury that pays dramatically in dollars. So the amount of revenue for financial repression from this third channel, which was significant for a while, has significantly declined and is not there. Moreover, when one looks at present policies and when one looks at elasticities, all this literature comes with those demand curves. And what's striking is you kind of go through this whole literature, and this is only less than half of the papers in that literature, and convert that into what the semi-elasticities are. It takes a little bit of work because the authors of all these estimation papers weren't doing it. You end up with numbers that are very large. And therefore, the potentials, if you want Laffer curve peaks for this third term, that are very, very limited. Yes, there are convenience yields. Yes, there is surplus there. But the ability to get those rectangles to be much bigger is much smaller. Let me finish up in this last minute before I conclude in 30 seconds by giving you then discussing present policies that are forms of financial repression. Note, to be clear, that there are many policies that may be justified for welfare grounds, much like Pigouvian taxes are justified for efficiency grounds, but they also raise revenue. And remember, financial repression is, can you raise revenue to pay your twin debts? Let me give you five examples with an impact for the euro area. First, the ECB decided a year ago to stop paying interest on required reserves. That is financial repression that harms liquidity in interbank markets and that generates 6 billion euros per year. It is a direct repression of banks by the ECB with consequences on liquidity. Second, the discussion of the European capital market, and Commissioner 𝗚𝗲𝗏𝗏𝗃𝗏 was supposed to announce something, I think she has already announced, is about to announce, that we will want to encourage European citizens to invest in private pensions who will be either constrained or highly encouraged in order to invest in the European capital market. That is ultimately financial repression, in that this will push down the required returns in the European market and generate revenues for our country and help us with our own external debt. Raising the inflation target to 3%. Very common among some circles, very popular. Using the tools in this lecture, that would generate seniors revenue of, for each percentage point of inflation, you generate roughly 0.12% extra of revenue. That comes simply from the amount of currency we have outstanding. The US has been providing foreign liquidity through swap lines since 2009. Perhaps less noticed is that in 2020, the US also created this FEMA repo line, which also lend dollars out to foreign countries, but where instead of lending those dollars in exchange for your own currency, whatever that's worth, now you can borrow dollars from the Fed by pledging treasuries instead. It seems very tempting for an administration in the US to tell the Fed to cancel its swap lines and keep the FEMA repo lines. The exact same liquidity reaches everywhere. But what's the difference? The ECB would now have to accumulate a bunch of US treasuries in order to be able to pledge them whenever he wants to borrow. That is financial repression, because that pushes up the demand for it and therefore pushes up Again, financial repression in this case is pushing up the blue demand to the right and therefore increasing the size of the rectangle. The thing is flashing over time, so let me finish with conclusions. Conclusions. Financial repression policies raise revenue through three terms. And adapting what you may call, what one calls debt sustainability analysis, to instead be an analysis of where can the money come to solve the twin debt problem, gives, I think, an insightful way to think about where could the repression policies be from the perspective of how much money can they generate. They are coming back because there's large gross debts and there's a large twin debt issue. Will they be adopted? I think so. Will they be effective? Was the question I tried to answer. They are very tempting, but what I tried to do in this lecture and in this keynote is to tell you that as much as policymakers in your individual countries and politicians elected will find this highly tempted, I think my reading of the evidence, which I hope more will question in the next few months, if not years, is that this is actually a chimera. It's really not promising. I come from this from a historical perspective again. In the 1980s, it was very tempting to say, why don't we inflate a little bit? Inflation solves a lot of fiscal problems. It took an enormous amount of pain, especially in Latin America, but not only, to learn that inflating away your problems does not solve your problems and causes a lot of wreckage in the meantime. I worry that we will be going down the same path 50 years later, not with unexpected inflation, but with a broader set of financial repression policies. I think, or as an economist, I'd like to warn the policymakers that before they do so, that they will not deliver large revenues. And trying to do more and more and more, like we did with the runaway inflation of the 80s, is not going to generate more revenues because there's a very clear limit to how much revenues these are, and they're not very large. You cannot tax the financial sector. Unexpected inflation is very limited ability, and the convenience sales and services have already started evaporating because their LSEs are very high. Moreover, in doing so, much like the runaway inflation of the 80s and some 90s led to a destruction of the financial sector and an increase in informality, an overuse of financial repression will lead to a rise of offshore markets and make the LSEs even larger and lead to a segmentation of the international financial market. Thank you very much for your time and attention.
Thank you, Ricardo, very much. Before we get on with the panel, I would like to open the floor to a very quick round of questions for Ricardo.
Thank you, Ricardo, for that excellent keynote. So maybe a question from my side on stablecoins. How should we be thinking about stablecoins in this context?
Very good. I skipped that one out of time, so excellent question, because it allows you to do the thing I skipped. I'll go ahead and, oh, no, sorry. There you go.
Thank you.
Of course.
Just one question more theoretical, in a sense, to see whether I get the gist of your reasoning, and one empirical or historical. The first one is, in the end, I have the impression you come to a result that is pretty close to the zero benchmark. So does this mean that in the end, if you think of the discounting factor in terms of stochastic discount factor, in general equilibrium, things move up that you cannot change very much. The result, is this the correct intuition of the underlying model? The historical empirical question is how you square this conclusion with the widespread please feel free to contradict. I mean, understanding that after World War II, when the debt were at the level we are now, through inflation and financial repression, governments were able to drastically reduce their debt burden.
So, Ricardo, I actually want to follow up on this last question. And perhaps I'm also giving the answer in part. So after World War II, we had a large amount of debt, but this was coming from military conflict, So now we're looking at a similar level of debt to GDP ratio, but with very large promises that make debt projected to increase even more. And so it's almost like you are really trying to go against the wind here. So the reason why possibly none of these measures can really be successful is because you are really you have promised so much to the public, and so far there is no discussion of what we are going to do about these promises. I mean, we can fulfill them, taxing more, but it's not about stabilizing a large amount of debt. It's more about how do we stabilize the promises that we have made in the past and what they imply for the future path of debt.
Okay, should I? Yeah, okay. So 4 questions, 4 answers. Stable coins. From one perspective, when you allow a Peruvian citizen to have access to a stable coin in dollars, you are reducing financial repression. That person wanted dollars. They had a demand for dollars. They were unable to have dollars before. So a stable coin in itself, insofar as it's giving access to a foreign currency by an agent abroad who didn't have access to it before, is lowering a financial repression. Okay? First point. The financial repression, of course, will be not to allow them to do that. You may have an argument for why to do that. Peru may want to keep its monetary sovereignty and keep the Peruvian peso to be the dominant currency. But you are repressing because it turns out that there's a dominant medium of exchange, store of value, because maybe you haven't been running your monetary policy all that well, that people would like to have access to. So first, stablecoin in itself is a reduction in financial repression in that perspective that I just said. At the same time, that generates a revenue. That generates a surplus here. That surplus with a private stablecoin gets appropriated by the private sector. When you now say that the stablecoin issuer, as in the Genius Act, has to hold treasuries, what you're doing is converting a producer surplus into a government surplus. So it's an efficient form of financial repression, not an inefficient one, because all you're doing is transferring the rent as opposed to create the rent in the first place. But of course, it was a government policy that created rent in the first place. Let me add a provocative point, which provocative meaning I don't buy it entirely, but I think it's worth considering in this discussion. Bob Mundell, in his Nobel Prize lecture, noted that exchange rate volatility, he called it, is a form of financial repression. Because he said there should be no exchange rate volatility, we should have an international currency. Insofar as you're not letting the Peruvians hold dollars, but you're forcing them to hold Peruvian pesos, he would call that a financial repression. And there's an element of that argument when I made here on the stable coins. And then the question is, how do you transfer the surplus or not? Second point, did I say that was I back to the neutral result where there's 0? Not quite, but thank you for the question because it allows me to clarify it. Those different terms potentially are large. The literature has documented that, for instance, the expected price of value of the discounts is quite significant. As I showed with the unexpected inflation, it goes through, let me go back to that picture, the expected inflation could accumulate over a decade to be 10, 15% of GDP. However, the long-run benchmark that if I average over 70 years, they are 0 is true. So if you're really bound by efficient financial market hypothesis, you are right, but you have to wait 70 years. Because over 10 years, you could really get a very significant amount in some ways. So no, we don't get that these things are 0 year to year. More importantly, perhaps, the goal of the lecture was not to measure each of these terms per se, but how much can policies push them up or down. In other words, the budget constraint has all of these 3 terms, or those 3 terms, but repression is to use policies to try to boost them up and down. These terms may be large, but when you try to use directed policy to increase them, you may learn that you can increase them very little. That the ability of policy to influence is very small. And that is, I think, what I showed or tried to show you, read the literature, that the same literature that says that the exorbitant privilege is very large, for instance, or that senior is what it is, when you look instead at how much can it be higher or lower by Swiss government policies, you end up with very small numbers. So you don't have to say that the STF makes these all 0. The point is a derivative point. It's the delta of the SDF times those points, delta policies. can that be large and that one is small? So I confuse you with a slip of derivative, let's put it that way. So not that these terms are small, but rather that policy cannot have very large sustained effects for a very long period of time. Third, non-policy, history. So post-World War II, we did a significant amount of financial repression. In the case of the US, it's really those first 6-7 years till 52 that are really play a large role. And we did lower the debt burden significantly. Note that, by the way, I also showed that after the pandemic debt, you also did a significant amount of financial repression insofar as purely unexpected inflation led to 8 percentage points of GDP in the US. So there are some significant amounts in offshore oil. Note that at the time, that financial repression lasted for much longer, those 5 years. But I will start with, did we financial repress our way out of the World War II? In part for 4 or 5 years. We're already past that. Maybe we should have done a lot for financial repression in 2021, but either we forgot or this is as much as we were able to do. Because what happened then was that, of course, the extent of interference in financial markets that we had throughout the 1950s then, and even 1960s, is well beyond what we have now, and generated, of course, the entire literature on financial liberalization and repression, again, McKinnon, on how highly distortionate that was for the revenue it cost. But 2 answers. First, from an accounting perspective, a lot of the repression of, when you do the accounting, Holland Sargent, Larry Ball, and others, a lot of it comes between 45 and 51. Then it's just a little trickle of 1% for 20 years. It matters, but it was quite a bit, depending then on how you count the 70s, of course, and the expected inflation there. But like I said, the 70s, you do a lot of it, but then you have a lot of unexpected, not inflation, but deflation or underinflation for the 15 years later. So it averages out to actually not much. But as I was saying, you did a lot of financial repression the first 5 years. That was very effective, depending on how you calculate it, as much as 20 percentage points of GDP. From 50 onwards, you find the limits I found. You're generating 1.5%, and then you do it for 20 years in a row with massive losses in welfare. That's certainly what comes up from the accounting that has been done for the US quite thoroughly in other places, and the welfare loss on that side. Finally, on Francesco's question, absolutely, and that's a point that my measurement exercise here was not able to explore. To what extent are those elasticities especially large, and therefore your ability to raise revenue small? Because people anticipate that given the debt problem, it's so large that these are persistent shocks. Persistent shocks are shocks towards which my elasticity, longer elasticities, key principle economics, are bigger than shorter elasticities. If I expect that that problems will continue, I will respond especially quickly and substitute it away, therefore limiting your ability to financial repression. There will be an argument for why exactly these terms may even be smaller than what I found, and which leads me really to my last point, which is that if we were to do larger scale financial repression, one key elasticity that would emerge now would be the appearance of offshore markets. And I'll conclude with that. When we went through a second round of financial repression after World War II was, if you want, the 1970s with unexpected inflation. And what was the response to that? Was that a new elasticity, if you want, showed up, which was the euro-dollar market as a way to escape some of the problems of that. An offshore market emerged to avoid that financial repression. Today, with a higher level of sophistication we have of financial activities, with a higher mobility of capital, I worry that if we insist on this, more offshore markets will appear from Dubai to London to somewhere else. And therefore, even the 70s, which wasn't actually that much, will even be lower now, precisely for the points that Francesco was making. If we think the problem is more persistent, it's worth investing in creating a market. There's cost to fixing markets insofar as they allow you to escape the repression that is coming. Thank you.
Thanks so much, Ricardo, and good afternoon, everyone. And let me then transition from this very interesting talk on the financial sector, financial sector policies, more on the framework side, the other side of the disruptions and deficit and debt implications of the current geopolitical environment. And we will do this together with 3 panelists that I have the honor of moderating this afternoon. The first one is Angela Delia, then from the European Commission, Ethan 𝗚𝗲𝗍𝒂𝒃 from the London School of Economics, and then Philip Rother from European Central Bank. Angela is the head of unit for sustainability and public finance at the European Commission. She really sits at the heart of the engine that in the European Union has developed the European governance framework and is maintaining, applying, and moving on with the activities of surveillance for the to survey the activity and of the countries in the context of this framework. Then we have Philip Rother. Philip Rother is head of the fiscal surveillance section at the European Central Bank. Philip has a long-standing experience on dealing with fiscal sustainability issue, and he will also help us explore the interaction between fiscal behavior and monetary condition. Last but not for importance, also to wrap up the discussion, we have Professor 𝗚𝗲𝗫𝗫𝗫𝗫 that has been working very much on fiscal policy, the dynamics, and particularly with focus on defense spending that is particularly important and relevant for us. Moving from this podium into this chair for a more colloquial type of discussion. And thank you also, Ricardo, for staying with us and be part also of the discussion in the subsequent round. Let me start with you then, Angela, and really starting and building from your vision and your experience, how the level of disruptions, uncertainty, policy uncertainty, geopolitical shocks that we are observing are accounted for in the current economic governance framework. And if we start looking forward at what should be the way policy should react to accommodate for these changes, what are the trade-offs and the challenges that fiscal authorities face in addressing these issues? Thank you.
Yes, thank you, Giovanni. Thank you for the introduction, for the question, and also let me thank the organizers for inviting me at the conference, for having me at this panel today. So indeed, as you said, I think it's a fact that the European Union is navigating an increasingly complex international landscape. I can name a few factors, be it for the war that we have since a few years at our borders, be it because of the shift in the policy orientation of the US, and more specifically, and I know the next panel will go into it, the shift in the trade relationship with our closest economic partner. All these has profoundly changed the economic and geopolitical and security landscape of the European Union, and it has come with an unprecedented amount of uncertainty. Now, on one end, and we have at the European Commission published our autumn forecast just a few weeks ago, our economies are showing resilience to these challenges. The growth is projected to continue, although at a moderate pace. But it is true that when you look at it from a fiscal perspective, from the perspective of public finance, and I will come to the fiscal framework in a moment, this puts huge pressures on the public finances of our member states. Now, how the fiscal framework, and this makes, and this is why I'm very happy to be at this conference, this makes the topic of fiscal sustainability, debt sustainability, more relevant than ever, because basically we will have a very narrow path to navigate, because on one end, especially for some member states, there is a need to have a reasonable and debt reduction path, credible debt reduction path. At the same time, and I will cover also this in a moment, we have to preserve the fiscal space because there are a number of policy priorities that need to be addressed. And now we have also the new challenge coming from the changed security setting. Now, coming to the framework, indeed, as you remember, basically we have a new set of fiscal rules since a bit more than 1 year, almost 2 years. And the debt sustainability analysis is central to this new framework. Now, when it comes to the specific and emerging challenge of defense and to have to increase the defense spending, basically the Commission has been doing a lot of things over the past months under the umbrella of Readiness 2030. But when it comes specifically to the fiscal rules, we have in March this year encouraged member states to to activate the so-called national escape clause of the Stability and Growth Pact. It's a clause that allows member states to deviate for a given amount from their endorsed expenditure path. Why we have done so? Because basically there is now total awareness that Europe has to take responsibility for its security, and then there is a need to ramp up in a swift way the defense capability of the Union and the industrial production in the defense sector. So basically, with the encouraging member states to activate the national escape clause, we have given basically a temporary flexibility, a temporary leeway, so that because it comes with a time horizon until 2028. So basically what we are suggesting is that for the next 3-4 years, the defense expenditure will be debt financed, of course, and I will come to this in a moment, is not a permanent solution, is going to be debt financed in the short term. And we have designed it in a way that the fiscal sustainability is not endangered. And here, I think I should have a slide, actually, yeah, that would help what I'm going to say in a moment. The next one. There should be a next slide.
You got the clicker is there, yeah. There we go.
Voila. Okay. So basically here I would have 3 main messages. Well, first of all, it goes, I would say, without saying that, of course, if member states exploit the flexibility that is given by this clause over the next 4 years, at the end of 2028, we will have deficit and debt higher than they were meant to be. So basically, the fiscal position, the budgetary position of the member state will be in 2028 less good or even worse than what we were expecting to have under the medium-term plan. The relatively good news is that because this flexibility is capped, so member states can only deviate by 1.5% compared to their expenditure path, the impact both on the deficit and on the debt is also limited. In the European Commission simulation, assuming a full uptake of and linear uptake of this 1.5 flexibility, we estimate that the average impact on the deficit in 2028 will be of 1.4 percentage points, and the average impact on the debt in 2028 will be on average of 2.7 percentage point. Now, the impact is limited, which is, let's say, relatively good news, but this should not be taken, if you allow me the expression, as a free lunch. And because basically the fact that at the end of 2028, deficit and debt will be higher than they were meant to be, it means then when it comes to the period after the national escape clause, so let's say as from 2029, our member state will have to adjust more than without the activation of the clause. And this is basically what you have on the second chart on the right. Here, basically, again, we have done some simulation to estimate what are the extra adjustment needs that will be needed after the expiration of the national escape clause. And here, basically, you have that the yellow bar are the amount of additional adjustment which comes on top of adjustment that would nevertheless exist also without the flexibility related to defense expenditure. And basically this is what is represented here by the blue bar, because, and this I can cover later if time allows, I mean, members, there are other spending needs, other spending pressures. Most of the blue bar actually comes from the so-called aging cost. So on top of the aging costs that were already present, there will be additional efforts needed due to the defense expenditure and to the fact that basically the debt in 2028, as I said, will be higher than they were meant to be. And this is basically also a key feature of the framework, the fact that there is a sequence of a multi-annual plans. So basically the end position at the end of one medium-term plan together with the growth prospect determines what are the requirements for the second round of plans. And here what we have estimated is that in the case of a 4-year plan, the average additional annual adjustment will be of about 0.4 percentage point, and which is reduced to 0.25 in the case of a 7-year plan. Now, the other message is that member states are aware that basically the fact that now they are taking advantage of flexibility to increase defense expenditure in the next 3-4 years, they know that this comes with a cost, that this comes with additional effort needs, and basically it's important that all the 16 member states that have asked for activation of the national escape clause, while asking the activation of the clause, have expressed a political commitment to take these additional consolidation needs and these additional efforts as from 2029. And I think this is important because, of course, fiscal sustainability is crucial to have a common framework, it's crucial to have it enforced, it's crucial to have good rules, but and is also one of the aspects of the reform, is also crucial to have ownership. So the fact that there is a national political commitment to take this extra effort is very important. And last but not least, and then you tell me if I have time to go in the other challenges and possible policy orientation. Again, the fact that we need to ramp up our defense capabilities comes with fiscal costs. At the same time, there are opportunities related to defense expenditure, and probably other panelists will go into this in a moment, so I don't need to elaborate a lot. There, the main message, the crucial message is that, and again, I don't want to step on other panelists, but I think what is important will be the composition of this defense expenditure. There are opportunities to privilege basically domestic European production over imports, to channel investment towards strategic infrastructure, towards R&D, to have spillover also in the civil industries. So if all this materializes, beside the aspect of the fiscal cost, we may have a positive spillover on the growth in the economic prospect of our member states. So this is everything I want to say in this time about defense. Now, let's go on other challenges. Yeah.
Let's perhaps keep them for the next round of interventions.
Yes.
Because I think what you are onto right now speak very much about the concept of fiscal space and is on how we can free up the space to absorb these new expenditure needs. And I would like then to jump, just to keep you at the end, if okay with you, to Philip, just to say, to look at you, because of course, if you take also what Ricardo was saying before, there is this big view, of course, the ECB wants to say, no, fiscal is fiscal and monetary, but fiscal and monetary interaction do affect, and we saw in particular also at the zero lower bound, also well historically, where the policy reaction function had a different shape, and they shape the way the DSA looks in the future, and the dynamics evolve over the future. So I would like to hear from you a little bit. What is your view on monetary policy and fiscal policy interaction, and how they affect and they can influence the capacity and the space to respond to the challenges that we are facing right now?
Yeah, thank you very much, Giovanni, for the invitation, for the organization of the seminar, and of course for the very good question. Of course, what you need to keep in mind when you think about the whole complex of fiscal monetary interaction, it's something super simple, but it's often gets forgotten. We have one monetary policy and many fiscal policies in the euro area. And that's something that distinguishes us obviously from most other currency areas, and creates major problems that we need to think about. And that's basically the core that you always need to come back to, that we don't talk about the euro area fiscal policy. Of course, you can always aggregate your deficit debt ratios, then come up with some aggregate numbers, but they have no policy meaning basically. And what is important to us as a central bank, maybe if you can go to the slides, is to keep that in mind. And I give you a few aspects of what we think about. These are just aspects, just a selection, not necessarily even complete, of what goes. Next. I'm sure your slides are much more interesting, but yeah, take this one. Okay, thank you very much. So let's go through, and this is actually also what Angela already alluded to. We put it here in the right-hand side chart as what we call fiscal gaps. So this is the amount of fiscal effort that would be needed to achieve certain fiscal goals. So this is kind of the most radical approach, assuming that governments would go to a certain primary balance as of next year to achieve stabilization of the current debt ratios, which are typically above 60%, to bring debt back to 60% over a 30-year horizon, and then cover for the aging costs that Angela already mentioned, and then on top cover for defense and for digital change and for climate change. So we just threw all the cost estimates that we could find in the literature together. This is super back of the envelope. This is not genetic equilibrium, but just to give you a sense of the fiscal gap, of the fiscal pressure that we think about, that we talk about. And of course, as I said, there's quite a dispersion across countries. There is a euro area average. We don't even show it here, but what is interesting is that this differs a lot across countries, whereas on the monetary policy side, we are forced to do one monetary policy for all. So this is a kind of the first snapshot. You can, of course, discuss every single figure in this chart, and probably on green and digital numbers would be rather higher. On defense, we don't know. We assume going to 5% expenditure based on the NATO target. But of course, all this is uncertain. But this is not the point. So basically, there's huge fiscal pressure, and the fiscal pressure differs across countries. So what do we as a central bank, think about the related issues, put it this way? One is potential growth plays a huge role. So on the blue line, what we do is we, somewhat extremely assume what we call the no fiscal policy change scenario. So we assume that, we use Commission data. Countries do as currently projected by the European Commission, and then they keep the primary balance at the current level. And for the high debt countries, which are the countries above 60% of GDP, 90% of GDP, sorry, this implies in the blue line already a sharply upward sloping debt curve over the next years. Now, if you assume that growth would come out lower, basically by one standard deviation broadly, so we talk about like 0.5 percentage points lower potential growth, you see that the debt path gets even more sharply upward sloped. What does it mean for the ECB? Of course, the debt problem will be much, much higher, but it also tells you something about what is the environment that we actually think about. This is about the European growth model. What is actually the model that will apply over the next decade or the next 2 decades that keeps European economies in the game? And this is not entirely clear currently. Angela referred to possible spillovers from the defense side, digital side. Green, had been heralded as bringing also growth impulses, but it's not at all clear. But of course, as a central bank, we need to have a view on that. What is going on the potential growth side? This is now for the aggregate of the high debt countries. For individual countries, of course, this looks potentially much more dangerous. Another aspect that we need to think about, maybe more closer to the central bank world, all this debt needs to be refinanced. You have rollover risk, you have to roll over existing debt, you have to finance new debt. And the blue columns here are the 24 deficits that need to be financed and the rollover. And then the yellow one is the change in gross financing needs from maturing debt, and the red is what has matured, basically. So that deducts from your refinancing need. The green line is 20% of GDP, which the IMF in research and in their own debt sustainability analysis uses as a threshold. It's not a warning signal, but it's something where the staff is encouraged to say, look, maybe you should take a closer look at what is going on the refinancing side. And what you see simply by looking at the white circles is that the number of countries are going much above the 20% line. This is not a complete disaster. This is probably feasible, especially if it's expected. There's ways to deal with it. But it's something, again, as a central bank, we need to be aware of what is going on in these things. the debt level itself almost notwithstanding. It's just to keep this whole thing working. Another aspect, of course, we as a central bank, we are holding much government debt by now, since the quantitative easing, and this will stay around for a while. We have policies to deal with it, but for the time being, it's on our balance sheet. We are major players in the market, and people will take any action that we announce into account for their own situation, for their own positioning, and we have to be very careful in how we communicate. Another aspect, which is again, not independent of the level of debt, but is important for a central bank because it will affect also our policies and how we communicate. And then one point. So far, this was all basically about expected values. We made a projection of debt levels, maybe of refinancing needs of our own debt holdings. It's relatively easy, and I would almost claim that this is the kind of easier part of the whole story. The tricky part is the shocks. This, of course, the expected values will not happen. This will not happen. There will be shocks. There will be surprises. There will be some disasters of whatever political kind or climate change kind, and that will kick you out of these projected path. And then the question becomes, how resilient are we? I just tried to show this here in this fan chart. I mean, this is now based on backward-looking BVAR methodology. This is how we do it. But of course, you need to be aware that what we essentially want to look at in debt sustainability analysis is not expected values, but is resilience to shocks around these expected values. Again, and this is what Ricardo also mentioned already, we are a bit in an uncharted territory here. We had high debt ratios in the past, and somehow we managed, with the help of financial repression, to get them under control. But to be also what Francesco said, to be at the high debt level, have all the commitments, and then still be exposed to shocks, we don't know what will happen. But again, as a central bank, we will need to be prepared. Just one short slide to get the market view. These are the ratings of euro area countries and the bond spread over the 10-year Bund, just to show that for each individual ratings level, so kind of the long-term perspective on fiscal sustainability, you might call it, there's a wide range of spreads over the German Bund. So basically, it tells you even if markets have a kind of converging view on what is kind of the fair risk assessment of an economy over the next 5, 8-year horizon, it doesn't mean that not in the short term spreads can vary widely, and again, this will affect massively our position in almost each governing council meeting, because then we have to decide what to do with interest rates and how that will feed into the market views. So these are just some aspects I wanted to give you. This is not necessarily one narrative, but these were the issues I thought were important to make as a central banker. Thank you.
And I mean, I was really fascinated by the first chart that you showed us on the role of just a small deviation in growth has on the dynamics of debt going forward. And I would like to pick this to really stress the role that growth can have in this current juncture. I mean, Luke, tomorrow he will talk to us also about the role of structural reforms. How can they affect the adjustment needs that both of you have highlighted going forward? But again, the view of growth, the big difference at the end of the day between now and the previous crisis, the great financial crisis, that we are here in a situation where fiscal is adding on growth, and we are not into a post-crisis situation in which we have to deleverage, adjust, and in a situation of deficit of demand. But this is my view, and I wanted to check a little bit also Ethan's view on, and ask also to put his slides on in the meantime, on growth, a little bit on what is the historical experience. What does this tell us in this environment? And also, how do you see the behavioral response of the changes, whether fiscal rules might be more performing or less performing in this different environment? And especially growth is what really interests me, I guess also the audience, in understand how will, and again, in our quest to identify the fiscal space that we have in front of us.
I have some thoughts about fiscal rules, but maybe I'll leave that for the Q&A and or the later discussion. So this is based on work I've done reviewing the literature on the historical literature on the effects of defense expenditures on economic growth. It's going to be in the annual review of economics in the upcoming year. And when I first wrote this, so kind of, well, I will give 4 lessons. There are more lessons in the paper that you are welcome to read, but for today I'll stick to 4 kind of lessons that I think we can draw from historical experiences. And in terms of the first lesson, one of the biggest questions I get is on the magnitude of the fiscal multiplier, because that's going to be a major parameter in estimating what we should think about the debt and other implications of the defense expansion. And when I started these discussions at the beginning of this calendar year, I found myself having to persuade European policymakers that a defense expansion is not going to destroy the European economy. And once the European policymakers have decided to spend the money, now I feel like I have to temper down an impression that this is going to be the solution to all of the economic growth problems of the European Union. And so I think the title that I've converged to this lesson is that there's neither a peace dividend nor a free lunch in an increase in public spending in general, but in defense expenditure specifically. And if you go back to the 90s, there was a large literature attempting to estimate the peace dividend that was gained from the end of the Cold War. And if you look here at the secular decline in defense expenditure in the EU and in the less secular in the US, more cyclical and slightly secular in the US, you can see essentially that, if anything, there is a positive correlation between economic growth and the share of GDP devoted to defense expenditures. I am certainly not claiming this is a causal relationship, but the point is that literature concluded essentially a 0 peace dividend, roughly. And you can see here why it's just very, very hard to get the data to confess a major dividend from the end of the Cold War. Now, why is it so hard to find the dividend? I could review the whole literature on fiscal multipliers, which I've written about. But rather than that, I think kind of just giving a historical episode of the largest increase in defense expenditures in human history, certainly as a % of GDP, to illustrate why the multiplier has to be somewhere around 1, probably a little lower than 1. And what you can see here is GDP from, during the Second World War in the United States, where the blue bar is civilian GDP and the green bars are essentially military expenditure. And what you can see is that during the war, the US economy adds another US economy to itself, more or less, in the form of defense expenditures. And somehow that works. There were capacity constraints concerns. Actually, Simon Kuznets, who invented GDP, was working for the government and said, there's no way your defense plans are unrealistic because essentially that would absorb 100% of GDP, which it did, but it absorbed 100% of 1939 GDP on top of only minor declines in actually civilian GDP. And then the war ends and all the military capacity gets absorbed in civilian capacity. That last point is a little overstated here because of this is in nominal terms and there was post-war inflation, so real GDP is not growing as nicely in the post-war. But roughly you're going to get something of a multiplier. If you squint, you can see that the multiplier is a little less than 1, but it can't be well below 1, given what we see from historical experiences. And that's pretty consistent with the estimates from the empirical literature. Now, the second point has to do more with the long run potential gains in terms of potential GDP, that is the productivity gain. So is there something different about defense expenditures that maybe makes it more amenable to long-run growth? And I think there is some very cautious room for optimism on this. And that growth can come from two and another one that I'll talk later, two channels. One is learning by doing. So these are hand-drawn charts from the intra-war period and the Second World War, showing the cost reductions with cumulative production experience. So it was observed that we produce more efficiently the more we produce, both in terms of the amount of labor, capital, and material used in production. In an article published last year, I updated this literature trying to see more of a causal estimate rather than a correlation. And what we can see on the left-hand panel is the impulse response in that same period in aircraft production of TFP to a 1% demand shock for aircraft. And we can see that the TFP gains through this learning by doing channel are actually pretty substantial, of about 1/3% already within a year of that increased production. But this has to be actual production, not plans for production, not spending on production, etc. The right-hand panel shows the additional response that you get in factories that were operating at the beginning of the war already at high levels of capital and labor utilization. And the reason we see this, when we investigate the mechanism, is that factories that are already producing at their production possibility frontier in terms of utilization of their resources move to adopt new production techniques in order to satisfy the demand that they are faced. So they kind of are willing to absorb fixed costs of upgrading their technologies because they have this secure demand coming from the government. I see this actually as an opportunity for Europe, which is operating within the world technology frontier and has an enormous opportunity. I think actually technology adoption is at least as important as innovation, which Draghi, et cetera, have talked about in terms of ability of Europe to increase its productivity. With that, this is the drone industry in Ukraine, which I'm actually now getting access to some data on their production, and hopefully I'll be able to show you that there's a similar learning by doing happening there. But anecdotally, Ukraine moves from not producing any drones to now outproducing Russia and actually exporting some drones to other countries while they're at war. And there's a lot of suggestive evidence that there is this phenomenon of strong productivity gains through learning by doing. The other channel comes from more the innovation side than the technology adoption side, and that is through the form of public R&D. And defense expenditure tends to be highly intensive in public R&D. And there's a large literature on the effects of R&D, and I think the estimates are that the effects can be pretty high. But I'd rather actually talk to you about what actually countries are spending and how they're spending their R&D euros or dollars. What you see here is for 3 different calendar years. So each of those bars are for one year, 2000, 2010, 2019, for several countries. The amount of real dollars, PPP adjusted, spent on non-directed research and development. So that's the kind of grants that we get. We go and say we have a brilliant idea to do research, and the European Commission decides to fund us. The colored bars are the mission-oriented R&D. That is kind of earmarked research and development for specific purposes. And the green share of that is military mission-oriented R&D. And what you can see is that there's a very big difference between how the US and the EU expend their R&D funding. Actually, if you add up the bars, they are about the same amount. But in Europe, it's very much undirected. And there are some suggestive, I think there's still much more research needed on this, but there's some suggestive anecdotal evidence that the directed R&D actually does gain higher yields in terms of patenting and other measures of innovation. Okay, the third part, bringing to our point, I may be a slight outlier here in I'm not unconcerned about public debt, but I'm probably going to be the least concerned on this stage and maybe in the entire room. So I'm happy to get the attacks later on, the hate mail later on. But I still maintain that this defense well, I guess you will agree with me that this defense expansion should be financed with primarily with public debt and not with contemporaneous taxation. And there are two main arguments for this. Number one, European policymakers say and will say and have to say that this is a permanent increase in defense expenditure. Because if you don't say it's a permanent increase in defense expenditure, then we'll just Russia will wait it out. But the reality is, I'd rather look at history than look at what policymakers say. The half-life of defense buildups in far more challenging circumstances on average than what Europe faces today have been 5 years. And so if you ask me how long this defense expansion is going to last, it's going to last about 5 years. A temporary expansion should be financed primarily with public debt, with long-run, only small-run permanent increases in taxation required to finance them. But at least as importantly, defense expenditure expansions tend to be front-loaded because you are doing a lot of durable good purchases. You are stockpiling weapons. Yes, there is upgrading and replenishment, et cetera, but there is still this first build-up stage. And optimal, optimization would imply that a durable good that is front-loaded should be largely debt financed. If we look at how the average U.S. military buildup was financed, it is about 50% through borrowing, about 30% through the economic growth, the fiscal multiplier, the revenues due to the fiscal multiplier, and only about 20% through contemporaneous increases in taxation. There is some work by 𝗏𝗏𝗃𝗏 and co-authors where they show a similar result for countries worldwide, and where the missing category of cutting other forms of expenditure is essentially zero on average. So essentially nobody increases military spending historically through cutting of other social or government spending programs. Maybe it should be optimal in Europe. I'm not saying that's a optimal response, but I'm saying as a matter of historical political economy, it was very hard to cut other forms of public spending to finance defense expenditures. Okay, the other thing that gives me some reassurance on the recommendation to borrow is the response of yields on the day of the German announcement of the suspension of the debt brake. And you do see, I mean, like as event studies go, you can see with your eyes the date where that's announced. Yields not only on the German debt, but on other, actually almost one-to-one other European countries' debt goes up by about 50 basis points. So that's not unsubstantial, but that's kind of one ECB tightening, essentially. I mean, it's not, this is not, we wouldn't be, running in panic due to a single ECB tightening. And if we look at the lower panel, this is the, cleaning out the increase in the real interest rate through inflation-protected bonds. From this, we see that the only a small fraction of this is in the form, so this is similar scale, so you can compare. Only a small fraction of this, about 30 to 40%, is through inflation expectations. And not through increases in yield. So I mean, you can think of this half glass empty, half glass full. But again, if you look at the fluctuations, this is not. It's a day that you notice, but it's not the only day you would notice in this half-year period. It's not the end of it's not the end of the world. If the markets are not reacting to this, to the largest fiscal announcement in Germany, and certainly in terms of loosening, it's probably the biggest since the Second World War. And it's there, but it's relatively small. I just here plot together with the US and the UK. Of course, you see a difference on the day of the announcement, but you see in the US and the UK some days that the yields go up by similar amounts on days that I can't even tell you what happened on that day. So I mean, this is not, this is not outside this is not, a 2 standard deviation effect. The last thing, and this is not in the paper because this is based on research in progress, hopefully we'll have a paper early next year, is on the type of jobs that defense expenditure creates. And so what we have here is, this is estimates of the skill requirements of different types of occupations in different sectors. The gray bars are civilian public occupations. The green bar is military occupations, and the red bars are private sector, with the dark red being manufacturing sectors, and the light red, the pink, being service sectors in the private sector. And what you can see, what kind of really stands out here, is that military employment has very similar skills as what we call, these are kind of types of skills here: repairing, operational, and control. So we've selected out those, without seeing the results, we have to ask the research to classify jobs into hard hat jobs and other categories. And what we can see here is that in the hard hat jobs, the type of jobs that Donald Trump likes to take pictures of himself with, or I guess politicians in general like to have their pictures with them and not with bankers. You can see that the military is very similar in terms of the skill sets. And our hypothesis that kind of is leading the work we're doing in this paper is that the military provided in the Cold War a large demand for exactly those occupations that we think are a little left behind these days, and not only created demand and therefore increased wages in those sectors, but also provided a training ground, internalizing the externality of providing general training to low-skilled workers that is transferable. And we think that actually military jobs have the potential to fill in some of those human capital, those low-skilled human capital components. I don't have time, but it actually turns out that overall military jobs, if we go to other categories like STEM, these are different types of military jobs, but nevertheless, military jobs are off the charts in terms of their science component. Management skills in all the public sector is very high, and the civilian public sector, as we know, we like to talk in these audiences. So on the verbal skills, but you can see that the green bars are always above average there, meaning that military jobs tend to be very high human capital jobs, and we believe that they're taking people with more challenging backgrounds and providing them that human capital. So that's all. I'll stop there. But those are kind of a few points for thought on the defense expansion.
Thank you so much. Very fascinating analysis that gives you a bit of more ground into and a bit of more structure into what we are talking about when we really try to look at the growth impact of defense spending in this case. But let me pick up again on one thing that you just mentioned that to me struck me as very much in line with the escape clause activation. Before you said, defense spending should be debt financed because of the nature itself of this type of spending, which in essence is what the escape clause allows for. Okay. Also, I mean, we were discussing also in other situations, and the escape clause. This escape clause is also very different from previous ones that were done to allow for temporary shocks like COVID, the energy crisis. This one, no, because defense should be a permanent increase because of it is its essential nature. However, under the governance framework, yes, this is a way to buy time. And at the end of the day, some type of reabsorption there should be. And of course, we can go through financial repression as a way and inflation as a way to reabsorb this. But also on your side, looking at all the different challenges that are also going granular at the budget competition, what is your view? What are the challenges that governments will face?
No, indeed. And if we can go back to my presentation, that would be helpful as well. Yeah, no, absolutely. No, indeed, you are totally right, Giovanni. This is exactly what the National Escape Clause does, is to allow a debt financing of the defense expenditure at least. Voilà, at least in the short term. Now, the fact is that the defense spending come on the top of more long-standing spending pressures. First and foremost, we have the aging cost, as I was alluding in the first part of my discussion. Yeah, just to give, I will not go into the detail, but basically this is a picture that these are the projection of the aging cost of our aging report from now to 2070, and by the different components. So coming from the pension, coming from the healthcare, coming from the long-term care, is a fact that the European Union population is aging. It's aging fast. The composition is really shifting in a fast way. We have fewer people contributing to paying the system and much more demand on the healthcare, long-term care, and on the pension system. So basically, you can see that spending needs will be increasing across almost all the member states and across all the categories, with the bulk of it coming from pension. Now, when it comes to the framework, these aging costs are already factored in our rules, in our requirements, because basically they are a key factor in the debt sustainability analysis of the Commission. So basically, when we define the adjustment needs for the member states, these aging costs are factored in. But most importantly, they are also the analytical background for a number of policy recommendations that we have been issuing through the European semester, but also more recently with the medium-term plan and the recovery and the resilience facility. And in the interest of the time, and we'll go to the policy implication just in a moment, I just want to say that next to the aging cost, we have also the spending pressure coming from climate change. There, we don't have time to go into this today because the channels are multiple. They can act on the supply side, on the demand side. We can have direct impact, indirect impact. So simply there is no time today, but there is a fact that extreme events are become more frequent and more severe. A few years ago, we have published a study studying indeed the impact of a one-off repetition of an extreme event on the debt of member states under two different warming scenarios, a 1.5 and 2 degrees warming scenario. And as you can see, this is just a selection of member states, but the impact on the debt compared to a baseline scenario is not negligible for a number of countries. And as a bit of a spoiler, we are going to publish in the coming weeks a new analysis factoring in both physical and transitional risk from climate change in the DSA. And we will, it will be quite evident not only the impact on public finance, but especially the upfront fiscal cost that member state will have to face in the short term. Okay, the good news is that this fiscal cost will be outweighed by avoided damages in more medium long term, but again, in the short term, there will be fiscal costs. So let me come indeed to what could be the policy responses, because it is a fact that we have a compounded spending needs, and the fiscal space is not huge, especially in several member states. So here we are thinking of a coordination across three different layers, three different avenues. I think the first thing, and a crucial one, is that, again, yeah, we can finance defense expenditure through debt in the short term, but again, in 4 or 5 years, there will be a need to rethink the composition of the public finance, of the public budget, and the quality of public finance. So it will be crucial that basically the budgets will deliver value for money. And in that sense, basically, it will be crucial for policymakers to really focus on those investments that are conducive to medium-term and long-term growth. And there, beside having a robust European fiscal framework, will be equally important to have robust national fiscal framework, because especially when it comes to public investment management, this will become a crucial dimension. So the first avenue of a possible solution is really to improve the quality and the composition of the public finance. The second avenue is that it's important that member states and the policymakers in the member states make the optimal use of the available EU funds. So this means that the absorption of the EU funds needed to become efficient and effective. We have the example of, again, the Recovery and the Resilience Facility that has shown that indeed the European Union can help in promoting and supporting investment also in those member states that have a limited fiscal space, but provided that there is a good use of this money. And there I would see space and scope for improving the public administration and once again improving the investment planning, also in light of the next multi-annual financial framework. And then the third avenue, I think that we need to recognize, here the conference is very much on public debt, but we need to recognize that there must be a role for the private sector. I mean, the competing spending needs are that huge that it's just impossible to think that everything will be shouldered by public budgets and by the intervention of the state. So we need to have a role for the private sector. Here again, I mean, for the policymakers, it's important to make the business environment conducive to private investment. And Professor Reis mentioned in his speech before the Saving Investment Union by Commissioner Albuquerque. Indeed, this is one of the latest initiatives by the Commission to channel private savings towards investment. And again, I mean, all this, none of this is a silver bullet. None of this will fix public finance forever. But in our opinion, these have the advantage of also to be conducive to growth, and at the end of the day, growth is the key factor for the debt sustainability. And I would stop it here.
Thank you so much, Angela. And also, let me invite everyone now. What's Ricardo, please?
Can I raise some questions actually to all three of you? So let's say we agree that a large investment in defense spending is needed, should be done, and should be debt financed. But then let me ask the next question to review. So starting with the first one is, as you noted, we just did a very large one a few years ago in the context of the Recovery and Resilience Fund and Next Gen EU. I think it seems paramount to ask, was that well spent? Was that needed? What were the multipliers out of that? Before we rush to embark on a new one, let's say, let's assess how well that was done. How far have we been? Because it's as if the one from 3 years ago, it's partly forgotten. You raised it, but in some way it's forgotten. But I think we should have to ask that question to kind of, before we're going to go to the next one, especially given that it makes perfect sense theoretically, let's say, that there should be a common European funding. And that's the sense we're talking here, because defense is as much of a common good as possible. But we just did a remarkable, I still remember certainly, Commissioner von der Leyen and others celebrating 2021, what a landmark event it was in 2021, being able to get these funds. And at what stage are we in evaluating what that is? And then to Ethan as well, those multipliers, of course, the wonderful thing about the studies and the way the academic literature has progressed is in terms of, it's not just about multipliers overall, but what do you spend it in?
Yeah.
And you made a very clear emphasis on technology transfers and adaptation and others. But even now, you were mentioning as part of the investments, improvement of public administration, which, well, and of course, when we talk about defense, we hear many countries talking about just funding a higher number of boots on the ground and reserve armies and others. I would expect those to have very, very different multipliers. So can you tell me a little bit how you think like the composition of the spending beyond just the total amount of spending? What have we learned from World War II and others in terms of where will the money be well spent from a sustainability analysis? And then finally, if I can ask a third question. Sorry, I'm taking a moderator view. But the third question is, to what extent, when you look at the size of the ECB's balance sheet and its holding of bonds, if we go towards issuing more commission funds and commission bonds, to what extent is it not also, or even just generally any other common form of debt issuance, or even sovereign bank securities, it could be with more or less joint separate securities. Let's take away the fiscal side of it. Wouldn't the ECB want to embrace more and more replacing all of this national government debt with instead European debt, insofar as it would save many of the problems that we have in terms of how to intervene, space, available spaces? So to what extent, if we were in an ideal world to do a big investment in defense spending and funded with European, similar to Next Gen EU, RF, going back again to the lessons from that, why wouldn't the ECB just move more and more towards holding that debt and less of individual national debt? Sorry, I took away the moderator. I thought some questions raised.
Yeah, no, thanks a lot for your question. Yeah, let me start perhaps because indeed we have elaborated a bit on the possible growth and spillover effect of this defense spending. But I would start from the fact that the very reason why we have basically activated the clause and allow to spend and to really go fast in spending more on defense is for security purposes. I mean, the first priority, the first goal is really to ensure the security of the European Union. Of course, if we have also growth, that would be good, but really the goal here is to ensure the security of our member states. And when it comes to the idea of having the spending at the European level, I think that, and even if I go a bit beyond my remit, I would concur, because while, I mean, in the literature, one could say, okay, the allocative function is better exploited at the local level, closer to where the need is. I think that when it comes to the defense spending, there can be a lot of arguments to go at the European Union level, also because, I mean, actually, in a way, although we are not yet there, it's also what the SAFE initiative is doing. Basically, now 19 member states have asked for SAFE loans. We have received the defense industrial plans by the latest weekend. And one crucial element to be eligible for these SAFE loans is indeed joint procurement, which is I mean, it's not really European budget spent on defense, but the idea is there that basically we need to have joint procurement, also because it's a fact that fragmentation is not helping. The fact that we have a lot of small orders placed, it's really just, we are facing huge unit cost just because everything is fragmented. So I would totally concur with you. Now, you made a parallel with the recovery and the resilience facility. Yeah. And the Next Generation EU in general. And there, again, also in the interest of time, I cannot go too much into details, but okay, probably the jury is not completely out, but we have been starting publishing over the past months a number of studies that study not only the impact on the, let's say, on the economy of the specific member states that have received the grants and the loans, but what is emerging is that there is quite a significant amount of spillover across European economies thanks to the deployment of the recovery and the resilience facility. And there I think really the innovative aspect was that compared, for instance, to the traditional cohesion funds, is that we were not just paying for investment, we were basically paying, first of all, for reforms that would create the environment for investment. I think that the reform aspect was actually the most important lessons from the recovery and resilience facility, the most important novelty.
Thanks so much.
So to kind of take your points to me in turn, to channel the FT, there is a big question of how to spend it, and I think it matters quite a lot. If you try to meet your 3.5% of GDP target by having more generous pensions for your service people, that's not only going to not have large multipliers, but not even increase your defense. So that really, and sadly, there are a few EU countries that have, opted to go for that direction. So certainly the highest return spending is on public R&D, followed by, mass procurement of, mass-produced goods. That's where you can expect the highest returns. I think it's to get those economies of scale. I think it is indeed important to think about this at the European level. On the debt sustainability question, again, to kind of take a quote out of context, I think with defense expenditure, it's a little bit of a case of if you want to get there, you shouldn't start from here. In the sense that I don't think that this increase in defense expenditure is the structural problem that the EU countries have in terms of public spending. There is a massive structural gap between the commitments, and I hope you let us go.
No, you.
I should not have the warning signs there. Between mainly the transfers of EU countries to their citizens that have been current and, as Francesco pointed out earlier, promised in the future, and the tax systems. And the way to get this, and are deeper reforms in terms of tax reform, labor market reforms, and which labor market reforms have the dual fiscal advantage of removing people from welfare and making them pay taxes. So you get both sides of the balance sheet, and tax reform. And one thing, just to kind of end on a again a controversial and maybe pessimistic point, I think one underappreciated disadvantage or side effect of the fiscal rules has been that they disincentivize deeper reform from a political perspective. Because as long as you're epsilon within your fiscal envelope, then you're fine. You can come to your voters and say everything is okay. The way we used to solve these type of problems is, debt would accumulate, and then, there would be a kind of moment where hopefully before the crisis, that countries, did deep tax reforms and, deeper reforms. I think here it's trying to solve the fiscal problems, one discretionary measure at a time. Even, in the case of France, that's, trying to do something. It still looks like just trying to patchwork a structural problem. And I think kind of an unintended political economy consequence of the fiscal rules has been this patchwork to meet the rules as opposed to deeper structural reform. We look at the one maybe success story in Europe today, which is Greece. The fiscal rule is nowhere close to binding for them. I mean, the debt, of course, has always been binding for them, but unbinding in practice. But the deficit rule is not binding. But they, because of their bad experience of the past decade, are doing these deeper reforms, and they are kind of the surplus champion of Europe at the moment. And I think that's something that other EU countries should take example from, whether their fiscal rule is binding or not binding at the moment.
Philip.
Yeah, thank you. Just to add on, Portugal, Cyprus, Ireland are also not doing so badly currently.
Yeah.
So just to add on that. The question, fiscal union, basically, is what you're asking about. Of course, that any move towards fiscal union would alleviate this inherent tension that I started with, where you have one monetary policy and many fiscal policies. The more we move towards fiscal union, the easier the environment becomes for the ECB. That's clear. And that's why also ECB has always promoted or supported any move towards fiscal union, of course, assuming sound, conditions and good setup. So from that perspective, indeed, it would make monetary policy and this monetary fiscal interaction that we talk about, much more kind of textbook-like and would make our life easier. And that has been also our communication on that. Just to end again, kind of to the flip side is, of course, the more you take out the national bonds then from this framework, the less liquid they become. And there will be continuing to be substantial amounts of national bonds outstanding with any move towards fiscal union. It will never be kind of a 100% shift. So you will end up with still many national bonds out there, which are not union bonds, and the union bonds will be much more attractive. So then you kind of shift the liquidity risk and all these kind of, cliff effect risks into this national bond market, which may actually destabilize at least some parts of the capital markets. And that's one of the, of course, obviously major arguments that you need to trade off and find a balance on the path towards greater fiscal union.
Thank you so much, Philip. Let me give you, even if we have this flashing light that is scaring us, if there are a couple of questions from Martin here. Martin and Ernest.
Yeah, perhaps I can start since I have the
please.
the mic already, and then Martin, you, for the sake of time, I have a question for Ethan. So I'm sure you've been looking at all sorts of differences between the United States and Europe when it comes to defense spending, quantity, quality, etc. What I'm interested in is the possible growth impact of the coordination gap. So when you look at DARPA at the United States, the process of assigning projects to companies is competitive, but it's also very well coordinated. So what Boston Dynamics is doing, the Texas Instruments is not. And one doesn't get the impression that that's the same in Europe, that there's the same central visibility and coordination and the distribution of products. What would be, like, how much could Europe end up paying for the lack of such coordination?
Should we collect?
Yes, let's go, Martin.
Okay, thank you. Thank you for this great discussion. I have a question to Angela. You showed this very nice picture with the exercise that tries to put a price tag on the neck and the national escape clause, and you say that it's not a free lunch, and at the end, the countries that applied for it, they do not jeopardize long-term sustainability. Now, what is implicit in, and that's another question, what is implicit in this graph is it's not all EU countries. Some have not asked. I think we know why they have not asked. So the question is, from your perspective, what does this exercise say about the sustainability of financing a higher defense spending with new debt? So I buy fully the analysis that you have done, but as I said, not all countries have applied for that, and I guess there's a reason. If I just may, a question to Ricardo. Ethan, in one of his slides, showed this event when Germany announced the big packages. And then what Ethan, I think, did not really mention explicitly, at the end, then the level came back to where it was before. But at that moment, there was a parallel shift. There was also a parallel shift, so also for other countries and also for EU debt, what we call EU debt. What does that tell you? What is your interpretation of that in view of a fiscal union? Thank you very much.
Let me group these two questions. Lucio and Ernest, I will give you the floor later on. Quick answers to address these two questions.
Where should we start from?
You start perhaps with you, Angela.
Okay. Yes, on Martin's question, no, indeed, you are right. Perhaps just one precision. It's true that we have 16 member states that have asked for the activation of the clause. It's also true that there was no time limit. So in principle, there is still time, and the member state can still make their mind and ask for the activation of the escape clause. And I may know of some that is thinking along these lines. But you are right that basically a number of member states are concerned about their debt sustainability. So they have taken in a aware way a prudent stance, not to overburden their debt with this defense expenditure. And actually, I think that what this tells us is that, at least from my perspective, is one of the first success. I know that there is a lot of criticism about the new fiscal framework, but basically, I think that there are a couple of success stories, and I think that the fact that now having a prudent fiscal policy, being concerned about debt sustainability becomes a bit central to the political debate of a number of member states, I think is a success story. I can tell you that basically we have now evidence that something that from our perspective sounds very technical, our reference trajectory, the net expenditure growth path, have become central to the political debate in so many member states. So I think that there is a success story that is not only ownership of the plan, but also ownership really of the fiscal policy and becoming prudent. So this is what the exercise would tell me.
Yes, I'll actually also respond on the just very one sentence on the event study that I showed, that another possibility that I didn't get into is the possibility that economic growth is projected from the defense expenditure. So these are real interest rate increases because the natural rate of interest is going up. I wouldn't put a large weight on that, but that is kind of a possibility that would be a Europe-wide thing. In terms of the how we spend it relative to the US, I think the biggest and most important difference is the amount of military imports that the EU does. So I mean, about 70% of the materiel is imported largely from the United States. You know, what Trump wants is for Europe to spend more and to spend more on US equipment. And so, you know, the strategic independence has to be a two-way street in some sense. You know, Europe has to, you know, repatriate a lot of the production. I wouldn't over-romanticize how the US spends its military. I mean, you know, we've talked about the military-industrial complex for nearly a century now, and the branches of the US military, Navy, Air Force, Marines, etc. Each one has its own procurement agency that barely talk to each other. I mean, it's better and better over time with the Joint Chiefs of Staff. But essentially, the Navy has an Air Force in the US, which you'd say that when there's already also an Air Force, you could say that's entirely duplication and wasteful spending. There's some rationales for that, aircraft carriers, et cetera. But, a lot of this is just legacy institutions and, independent bureaucracies. And so I wouldn't over-romanticize the degree of coordination there. With that in mind, I think there are a few ways that the US does. The US actually, despite the claims of military-industrial complex, actually spends on far smaller producers on average than the EU does. The EU relies much more on the, I was going to name names, but I won't name names, but we know where they're spending in Germany, we know where they're spending in Italy, you know the names of these corporations, and we know where they're spending in France. And the US does a much better job in going deeper down into the firm size distribution in its procurement. There is much more procurement from dual-use companies, which has larger spillovers to the private sector. So I think there are a whole set of lessons. I mean, the paper goes into a lot of detail on these procurement questions, but I think there's a lot to do, and I think a little more. There's not going to be a European Defense Ministry anytime soon. maybe some coordinated expenditures, but the more we can move towards a more coordinated and not these bilateral deals between each pair of EU countries, I think the better.
Ricardo.
Sure, we'll go to me. No, I think, so going back a little bit to my question, I think the issuance of the EU bonds in 2021 was a great experiment. And we're learning exactly how that worked in terms of how markets interpret it and what that implies to fiscal policy in the future. The fact that, are they really the beginning of a fiscal union where we think that those bonds are ultimately backed by each and every sovereign member in a joint solidarity state, which is not the agreement, but could easily devolve into it? That would be consistent with the movement of all of the bonds in the same way. That essentially, if you think that Germany is the ultimate fiscally responsible one in backing it, and any erosion of by 1 percentage point of Germany would show up with the EU bonds eroding by 1%. And there would be some evidence in that regard. Whereas at the other extreme, if you think that the EU bonds were really very circumscribed to next gen EU recovery and resilience, and they are funded by the European Commission's budget, which is in part only affected by German fiscal situation, but only to a certain extent in that it affects the negotiations of future multiple annual plans, then you'd expect the response to have been much less. So from that one data point, you may say that these EU bonds may look a lot more suspiciously like Euro bonds than really what we were sold in 2021. It is one data point as of now in terms of that. But I think absolutely we're learning, and part of, again, my question to Philip and the discussion we had was the extent to, and I've written for 15 years very critical about Euro bonds and how we should not go into fiscal union in many regards, and or at least in terms of creating better debt securities that would separate the waters in fiscal union and others. But I think we do go to my question to Philip, and some work by Luis Garicano and some others that has shown that the liquidity of these EU bonds is also very limited, partly because of how the ECB treats them and not. Going back again to my answer, which is we're learning the treatment of these EU bonds, what they'll evolve. Every data point is helping us to understand what place they will have. But also, and that was really my question to Angela, was as we embark into more common spending and we think, does it mean that the next one should be paid by EU bond again? Or should we instead look at national debt or even other Euro bonds at the other extreme or others? I think those are the right questions to ask in the setting in this institution. We should not take the 2021 answer as given, but learn from it, including the observation you made, towards our step towards, I think, a more stable union, not necessarily a fiscal union and not necessarily a joint debt instrument, but figuring that out.
So very fast because we are horribly over time. But Lucio, one short question.
About the growth effect of military spending. So two aspects. One, the multiplier. There is an obvious problem of exogeneity every time you go for multiplier. And I had in mind and actually double-checked the famous paper by Barrow that precisely uses surprise war, the Korean War, to estimate multiplier. And its multiplier comes closer to 0.5. Actually, 0.6 is the central estimate. So is not your assessment of multiplier close to 1 a bit on the optimistic side, bearing in mind the difficulty of measuring? Broader point of the effect of growth. In my view, the story of the elusive peace dividend boils down to the fact that military expenditure was reduced, but essentially we had documented for several European countries a case of crowding out by social expenditure of other type of productive expenditure. Now, to conclude the provocation, a private conversation with IMF colleague was telling me, well, of course, if in the UK they cut invalidity benefits and increase armament production, there will be a positive effect on GDP because of the scale and learning economy in producing ammunition. Maybe some people will remove from the welfare rolls, some people may be removed from the population registry. So sustainability-wise and growth-wise, you would have a positive effect, but not one that quite a part of the population is like to approve of.
Short point, thank you. I want to follow up in a way what you just said before, Ethan, and what Lucio said. So I see possible tensions arising with the military procurement increase, with a big increase in military spending. So there are competitive issues. This is a concentrated industry. The question is, what value for money do you get? I just read a newspaper article about the company in Europe producing weapons, Rheinmetall. So they are having severe difficulties in Germany. The discussion is whether their profits, ballooning profits, shouldn't be taxed. They're excessive profits because public acceptance is waning. There's a question of efficiency. You talked about economies of scale that we don't have because it's fragmented. And there's also, of course, the question of proper governance. Whenever armament is involved, there is also the risk of corruption and so on. And you mentioned the example of Ukraine building up rapidly the production of drones. So we also have the issue, do we have the sense of urgency as, for instance, Ukraine has? Of course not. So we cannot manage as fast. We will not manage as fast because there isn't this sense of urgency. So I think there are issues of public acceptance in times of also needed cuts in social spending, etc.
Super fast.
Okay, just one data point. It is not true that 75% of our armaments production is for requirements are imported. Actually, the other way around. It's around 80–90% that is domestically produced within the national countries or at least within the EU. The only area where the share of the US is high is in airplanes. All the others, it's basically 90% European. So most of that demand stays in Europe.
So on the last point, we can follow up later on. I'm quoting from the Draghi report. So I don't know. Okay, so let's. I'm very happy to update my view on this. Yeah, on the fiscal multiplier, there's been 40 years of research on the fiscal multiplier since the Barrow paper you mentioned, and that literature, including papers that I've written, probably the median estimate in that literature would be about around 1, including Valerie Reis, who updates the exact idea of the. So it's possible that the Korean War specifically the Korean War is actually a very complicated case because you had maybe on average the multiplier is very low, but there was an immediate boom in GDP due to durable purchases by consumers, and then there was a collapse in GDP because everybody had all the durables they wanted. So I don't even know how to think about the multiplier in that context, but if we look on average over defense episodes and look at other contexts, I think 1 is not 1 or a little below 1 is not too bad an estimate with large standard errors on each one of these estimates. On the question of market power of the defense corporations, I think a lot needs to be done, and that's not only in the EU but also in the US, on the government exploiting its monopsony power and not only the other way around. And there are some good, we don't have time, but I mean, you could talk offline. There are some good examples of the use of government monopsony power. So we shouldn't take this, they're at least as much of a captive audience to the government as the government is to I mean, even more so in some extent, a captive. They have one client more so than the governments have only one supplier, and so I think that of course there's a political economy around this, lobbying, etc. But there's no law of nature that things have to be that way.
Thank you so much, Ethan. Thank you, everyone, but especially our speakers, Angela, Ethan, Philip, Ricardo. They joined us for this super interesting debate on defense spending, geopolitical discussion, but especially growth. and in the face of all the adjustment that the European countries will have to do, and the challenges that also the ECB will have to face going forward to manage a centralized monetary policy. Let's take a little break.
Let's take a break until 15:15. Coffee break until 15:15. So everything is postponed by 15.
We have a shift.
Focus on YouTube. That's right.
Back on stage after? No. Okay. Perfect. And then I only
I'm good. How are you?
I'm doing cold. Yeah, it's cold here. I'm in Nepal. I'm in Kathmandu. When Carl and I were in the same time zone for a while, I was in Malaysia. He was in Malaysia. The temperature was, I don't know, 90 degrees every day. And then you go to Jakarta, it's like 80, 90 degrees every day. It'd be 10 o'clock at night, it's like 90 degrees. And so you may have the fan on, you may have the AC on, but for the most part, it's nice. Like you're never cold. It's great. And then you jump into Kathmandu and be like, oh my God, 70 degrees, it's freezing. And then at night, it's like 60 something and it's freezing. And it's like you can never get warm. You just miss those warm nights.
Well, it's all relative, right? Words like hot and cold are relative, right?
It is. Carl one day told me, he says,
Lo puse de tapar. A ver, si le das a seguimiento, si te sale.
te preocupes, te lo pongo en rojo.
Pero matácalo, tío.
No, pero porque lo veas, porque el rendimiento luego tienes que pasarlo tragado.
Copio el texto y cambio el párrafo del este, no te preocupes. Estate cosa hasta arriba, tío.
Solamente ahora tengo un rato. Estás tú ahora después, si miras tú eso, ¿qué lo has conseguido?
Now, phrased in this way, geopolitical disruptions and debt sustainability is a bit reductive, because geopolitical disruptions, they change our everyday life, but they have also an impact on fiscal policies, obviously. So I would say that our world is experiencing rapid and unpredictable changes because of geopolitics. Never have geopolitics played such a big role since World War II. And the extent to which geopolitics is changing everything, including fiscal policies and debt sustainability, reminds me of a novel, which maybe not all of you know, but it's a French-Belgian author called Amélie Nothomb, and she has written a book, which is not her most famous one, it's called 𝗶𝗶𝗵𝗶. And this book is in the year 2400, so 400 years later, and there's a political prisoner. And the political prisoner is there, and every day or every week, there's a prosecutor comes to see him and tells him, you are still staying with your ideas and your principles. And I tell you, you're the only one who still believes in them. So you better give up your ideas, and so you'll be free. And the prisoner responds, I don't believe you, that you have abolished all the things I believed in. So I resist. And so the prosecutor says, what idea do you think still exists out there? You have been in prison for so long. And the prisoner, I'm in literature here, this is not economics. The prisoner says, you cannot take the South, written with a big capital S, you cannot take the South away from me. And the prosecutor laughs and says, I can see you've been in prison a long time. We have abolished the South. Why am I using this image, which came when I reread the excellent speech that was prepared by my team? Because I'm afraid we have to ask the question, is there still room for international cooperation? Is there still room for rule of law? Or have we changed paradigm completely? That's what's in this question. Have we abolished the South? So that's why our conference, I think, is so interesting. And obviously, if geopolitics is changing the pattern of international cooperation, this will disrupt multilateral cooperation and will challenge also the resilience of our fiscal frameworks. So in other words, I would like to state here very clearly that for me, geopolitical changes, if you like them or don't like them, this is not the topic. If the geopolitics as it is becoming now continues, how do we have to deal with economic equations, with fiscal policies? So I will structure my speech in 4 parts. I'm going to insist in part number 1 of the importance of growth for debt sustainability. Second, I'm going to speak from a maybe a little bit original angle about the Stability and Growth Pact. Third, dedicating a little bit of time on how to reprioritize expenditures, or in other words, how can we spend in a smarter way? And fourth, the relevance of debt sustainability for the ESM, but I would say not only for the ESM, but just for the EU. And that will relate to the Stability and Growth Pact. Now, why do I insist so much on the importance of sustainable economic growth for public finances? I think we have learned from the past 15, 20 years that our growth and productivity in Europe is too low. And we have focused on discipline, on budgetary discipline, and not sufficiently on growth. Sustainable growth brings increased revenues, higher employment, and business that flourishes. It improves the country's fiscal position. GDP grows faster, and if GDP grows faster, your ratio of debt to GDP improves. And basically, it boils down to the very simple equation, meaning the first thing you have to do is to bake a bigger pie. The bigger the pie, the more flexibility you have on expenditures. And unfortunately for Europe, if you look back the 10 last years, our growth has been far less than competition. Basically, between 2013 and 2023, our growth was 0.6% of GDP per year compared to the United States, which was roughly the double. Not to speak of China. We know this is an emerging country or a very quickly developing country where the growth was 6.4 in the last 10 years. But also, the cumulative growth, obviously, as a result of this productivity gap, we have had a growth of 15%, the United States of 30%. So this is traceable to the fact that our innovation and technology and entrepreneurship are less than in other parts of the world. And interestingly enough, the last Nobel Prize in economics went to, I mentioned them, Joel Mokyr, Philippe Aghion, and Peter Howitt, who said that and highlighted that innovation is the key driver for sustained economic growth. So how can we, and I stay here with boosting growth in Europe, how can we do that? We have to do, first and foremost, our homework. That's why I wanted to start with this part here, because it's useless to complain about geopolitical disruptions if you do not do first your homework. And your homework in Europe means obviously doing the right things in your country, but also to coordinate action and act in concert. And we have two excellent reports of two former Italian prime ministers, Letta and Draghi, who have produced excellent reports, which are only 1 year old, but what's in it is a medium-term, long-term program. And they tell us what to do, mostly is to perfect and accomplish the EU single market and work on productivity inside Europe. Now, let me say a few words on single market. Remember, the four freedoms of the EU single market is the free flow of goods, services, people, and capital. Now, on goods and services, there would be a few things to say, but let me dwell on the free flow of people and the free flow of capital. We are saying we have the free flow of people inside the European Union. That is true, but it's not happening anymore. There are not that many people moving from one country to another. Now, when we had the enlargement in 2004, this happened. We had lots of people from Oriental Europe who came to the western parts of Europe because there was such a gap in growth and lots of jobs. But now the flow of people is rather limited. The free flow of capital is also quite limited compared with the free flow of our capital and savings to the United States. So again, we have to do our homework and manage to channel our savings. Europe is the part of the world that saves most towards the European economy, towards our internal market. I didn't speak about now goods and services, so a lot has to be done there. I encourage you to reread the summaries of the Letta report on this. But on top of this comes, I would say, the four challenges that are obvious, which are overarching. So the number one, I stay with it, is geopolitics, changing in geopolitics and the impact of geopolitics on everything. The second one is obviously defense spending. Europe will have to spend enormously on defense in the decades to come, not in the years to come. First, in NATO, to reach the levels that were agreed of 3.5 or 5% in NATO, but we need to act together and develop an autonomous, I don't say independent, but autonomous defense capability, which we don't have yet. Now, this has some good factors and good consequences if the multiplier effect of this defense expenditures is positive, depending on how you spend that money, and also depending on how much you do together. So this is one overarching issue that I would like to highlight, but obviously we have been besides geopolitics and defense, we have climate change, because you might not like the issue of climate change, but it's there to stay. And the other one is aging population, which is, by the way, one of the reasons why there's not anymore the flow of people inside Europe that we used to have. Now, that brings me now to the second part, which is the Stability and Growth Pact. And here I would like to shed a light that is, I dare say, a little bit original. You might say it's not, but why am I saying this? The Stability and Growth Pact was seen by many inside Europe, and maybe even outside Europe, as an instrument that was good for budget discipline, but as something that stifles growth. That's how it was perceived, right or wrong.
Se pe intrare se nesta porcaria, estamos sempre a enganar.
But not least, we must make sure that investment is not the victim of whatever adjustment that happens. So the new Stability and Growth Pact, in my opinion, is not only mine, I think it's generally shared, is one that brings greater flexibility, more potential for growth, and also gives a little bit more time to countries to adjust, because you have to adjust to the net expenditure path either in 4 years, but you can even choose to do it in 7 years. Now, 7 years is not innocent, because that's beyond a legislative period. So it also gives a medium long-term horizon. Now, if we push flexibility too much, obviously you lose credibility. But I think that the European Union has found here the right balance, and in such a way that it should ensure in all our countries ownership of the Stability and Growth Pact. Obviously, having been a finance minister mostly in the last decade, the Stability and Growth Pact was a negative word. It was used in the media saying, oh, we have the Stability and Growth Pact. We cannot do this, we cannot do that. It's like Europe is slowing you down. Europe is a problem. I can tell you, having it is an advantage. Thanks to it, you will have more growth. So that's how I see the Stability and Growth Pact of today. Now, coming to the third point, and I have already mentioned it briefly, spending smarter. So having these overarching macro trends of geopolitics, defense, climate change, and population aging forces you obviously to make choices. So we need to be smarter in spending. First, we have to phase out expenditures that now not warranted anymore. That's easy to say. We've seen it with energy measures that were taken just after the COVID time, how much time it took for many countries to deactivate those measures. But more importantly, we have to act together in many areas. Defense, I think, is a good example. The European Commission managed to find headroom for 150 billion euro with the SAFE program for defense projects. You can only access those 150 billion if you have common projects, at least 2 or 3 countries. 19 countries have applied. Now, 150 billion euro can sound like a lot of money. It is a lot of money, but it is a low number compared to the needs in the coming years. And so we need to have much more of this. How we're going to do this needs to be seen. It is also good that a country as Germany has announced 1,000 billion investments in defense and logistics. But for the time being, what you hear is this is a German initiative. So can a part of that be used in common? Can other countries join in? I think this is key. It reminds me of something that we did with success in the past, which is Airbus. Today, Airbus is the world leader for aircraft. So we've been able there to have an industrial cooperation that is successful. Why can we not achieve this in the area of defense? So it is not sufficient as a summary, and then I come to my last part. It is not sufficient to boost investment, to boost productivity with the help also of budgets, national budgets, but we need to coordinate our efforts. So in a nutshell, what we need today is not less Europe, but more Europe. My fourth and last point is debt sustainability, which is the topic that you're looking into here today. Debt sustainability is at the core of the Stability and Growth Pact and of the ESM mission. Now, we have looked into this since our creation. And why do we do into that? Well, if we lend money to a country, as you know, we have assisted 5 countries, we want to make sure that we get reimbursed. This is common sense, but this goes with macroeconomic programs. I look at the IMF, they have taught us a little bit how you do that. We've learned a lot from you, although our setup is a bit different, but still, it's still the same reasoning. You want the countries to reform and to restructure to avoid to have the same problems they had the day before. And look at that, the 5 countries that got assistance from the ESM back in the last decade are among the European countries that are performing better and best. Why? Because they did the reforms. They had no choice. They had to do the reforms because that was the condition for their support. But still, it teaches us a lesson. If you do the right reforms, you will harvest the fruit. That's point number 1. Point number 2 in a period where we have not had direct support to countries in the recent past, our mission is also to maintain the confidence of investors and markets in all the sovereign debts of Europe. And how do you do that? Well, by preventing a crisis. So our role is double. We're there to support countries when they have big issues, but also to prevent crisis. So finding a healthy spending path and having a reasonable debt to GDP to stay the course is essential. So we are now in that phase here at the ESM, devising tools to help countries also read the future and see if their debt sustainability is ensured. Now, how do you identify risks at an early stage? That is not easy, and we have spent and we continue to spend a lot of time on that. Let me mention a few recent works that have been published. Now, recently we published a DSA toolkit, and it's called the ESM Scholastic DSA tool, and you will find that ESM brief available, and it was published yesterday. It's certainly going to be discussed also during this seminar. And this approach combines model-based estimates with country-specific expert judgment. That sounds a little bit barbaric, but when you read it, you'll find out. And in one word, it is that you try to project different forecasts, not only one forecast, to assess, to double check if the path is safe. And we take into account historical regularities and institutional expertise to measure that. Let me also mention an insightful research study prepared by DSM staff members and authors from outside, which will be presented tomorrow, which is called Funded and Unfunded Fiscal Shocks, Inflation congratulates the team for this. In conclusion, debt sustainability may appear as a technical benchmark. It is not. It is a key to prepare for the future. It also, this debt sustainability combined with the Stability and Growth Pact, European cooperative and collective determination for a sustainable, secure, and prosperous future. And this commitment is more urgent today than ever before. Then we need to combine two things: prudence, debt sustainability, and boldness, that is investment in the future. So I think those two principles, prudence and boldness at the same time, can guide you through the conference, which I hope will be, and I'm sure will be, fruitful. Thank you for your attention.
Hi, everyone. Thank you, Pierre. And now I would like to invite 𝗚𝗲𝗚𝗏 for her keynote speech. So you might know that she is the Deputy Director of Fiscal Affairs Department at the Fund. What you don't know is that she is one of the most efficient and pleasant people to work with at the Fund. And I say that firsthand. So please come on in.
I like the moniker, efficient and pleasant. So thank you, everyone. And it's a real pleasure to be here with you all today. Much has already been said. So what I will say will sound somewhat like a repeat, but hopefully with a bit of a twist. We're here at a pretty dramatic moment of change for Europe and the world economy. long-held assumptions about trade, about openness, are being upended. Geoeconomic fragmentation is accelerating. Economic decisions are increasingly being driven by strategic considerations rather than efficiency. We economists like efficiency. And all of this, as you've heard from previous speakers, is unfolding against a challenging backdrop. High public debt, low growth, aging populations, mounting pressures for defense spending. This is the new reality that policymakers must navigate. Layered risks that force us to rethink, how do we think about fiscal space in the first place? And how do we prepare for the next crisis, whatever that may be? So today I'm going to focus on 3 points. First, debt risks may be underestimated, even before accounting for trade disruptions. Second, trade disruptions are denting growth and could strain public finances even further. And finally, we need a fiscal policy toolkit that safeguards debt sustainability and strengthens resilience in an increasingly uncertain world. So this is not just about trade disruptions, it's fundamentally about uncertainty. So although I've listed debt risks first, I'm going to begin with trade disruptions. If I can just find the clicker there, here we are, okay? And I'm going to start with trade disruptions first because they provide a crucial backdrop or context for the fiscal challenges that I will turn to. So 2025 has been a year of heightened uncertainty for the global economy, driven by a fundamental rendering of trade policies. In the US, a series of tariff hikes pushed tariff rates to levels not seen in a century. With subsequent negotiations rolled back some of these increases, US tariffs still hover around the 10 to 20% range, which are extraordinarily high by historical standards. Perhaps what's even more disruptive is that trade policy uncertainty has surged. In the absence of clear, durable agreements, businesses face a fog of unpredictability. This 1-2 punch, higher trade barriers and greater uncertainty, is hitting economies that have already been scarred by recent shocks. And it comes at a time when, as we've all discussed, fiscal public finances are more under pressure. So in short, high uncertainty is colliding with high debt. Global public debt, as many of the previous speakers have already highlighted, was already elevated before these trade tensions intensified. After a brief post-pandemic dip in 2021, 2022, worldwide public debt started rising again. By 2024, it reached 94% of global GDP, and on current trends, it's expected to exceed 100% of GDP. Now, this surge is driven largely by the world's two largest economies, US and China. But I think it's important to underscore that debt is rising pretty much everywhere. In Europe, for example, public debt is expected to climb about 5 percentage points over the next 5 years, reaching 90% of GDP by 2030. How big is that? Well, that's nearly 10 percentage points higher than before the pandemic. So that kind of gives you a sense of the scale of how debt is increasing. But the challenge is not just debt, but also its cost, something previous speakers have also touched upon. In many major economies, borrowing costs have jumped in the past few years. As governments issue more debt, investors worried about large deficits are demanding higher yields to lend. In fact, if I were to decompose this and look at risk premium, how much of this is being driven by risk premia, much of this is coming from higher risk premia. And term premiums now, in fact, have reverted to levels not seen before the global financial crisis. And so for governments, the math is clear. Higher debt plus higher refinancing costs, higher interest rates are pushing up interest payments. In many countries, debt service burdens are already about 1% of GDP higher than they were just a few years ago. In the US, they've almost doubled since the period prior to the pandemic. We also face a turning point for debt dynamics. After a decade of very, very low interest rates and easy financing, we now have higher interest rates and weaker growth. And this kind of raises the bar for fiscal sustainability. Yet, many countries are still pressing the fiscal accelerator. I see it in the bottom right quadrant. So this is the countries in red, all those little dots that you see in red in this chart. A significant share of advanced and emerging market economies, including some in Europe, plan to maintain expansionary fiscal policies over the medium term. In other words, policy is not tightening in line with our warnings about debt. In some places, it's actually loosening. But the real message is this. Even the current debt projections that we've all talked about may understate the risks. Why? Because there's a persistent optimism bias in how we project the future. Time and again, projections assume stronger growth, more fiscal tightening, or lower interest rates than actually occur. In practice, growth often disappoints, crises are often unpredictable, as we know, fiscal plans fall short, and spending pressures, as we are learning, prove stronger than expected. So the IMF's debt at risk analysis underscores this point, as you can see in this chart. It shows that even before accounting for trade disruptions, a plausibly adverse scenario, low growth, higher interest rates, tightening financial conditions, could put euro area public debt nearly 20 percentage points of GDP higher than baseline projections 3 years ahead. Look at the tail of the distribution. And if global financial conditions tighten further or risk premia rise, the outcome could be even worse. And these risks are compounded by shifting political winds and growing polarization. Across the world, not just in Europe, but across the world, advanced emerging market economies alike, political discourse has increasingly tilted towards higher government spending. And crucially, this isn't just a temporary swing. It's a long-term trend across regions and across policy lines or party lines, political party lines. So in a recent paper with 𝗬𝗏 and Enrico De Gregorio of the IMF, we examined thousands of political manifestos of all parties since the 1960s. And what we found was that the share of political platforms advocating more public spending has jumped by nearly 40% over the decade. Meanwhile, calls for fiscal restraint by both left, right-wing parties have actually declined. In our paper, we show that this rhetoric often turns into reality. We causally show this. When parties campaign on bigger spending and then they take office, deficits tend to widen. And now today, with no new taxes, red lines hardening around the world, governments face a dilemma. Rising spending demands, but fewer easy ways to pay for it. And the bottom line is fiscal risks are elevated, and the balance of those risks is firmly on the upside. So that's the backdrop. Now I'm going to turn back to trade disruptions and their direct connection to fiscal outcomes. Tariffs, industrial policies, and efforts to reshore or friendshore supply chains may aim to enhance economic security, but they do come at a price. And we see three main channels through which trade shocks hit public finances. First, growth effects. Trade barriers and uncertainty act as a brake on growth, raising costs and reducing trade volumes. Fractured supply chains can hurt productivity and competitiveness. Second, spending pressures. Governments tend to cushion the blow with subsidies, with tax breaks, with transfers to help affected households and firms. They tend to invest public funds to bolster strategic industries or supply chain resilience. This strains budgets. And finally, borrowing costs. Volatility and geopolitical tensions drive up risk premium and borrowing costs. And these three channels that I've talked about, weaker growth, higher spending, and costlier borrowing, can reinforce one another. Over time, they erode fiscal space and leave governments with even less capacity to respond when the next crisis hits. So let's dig a little bit deeper into the growth